Good evening, everyone. We're excited for you guys to join us. We've still got a few people joining. Can you guys hear me okay? Feel free to answer in the comments down below in the chat. Okay, I'm getting thumbs up. Awesome. So today we're going to be talking about the one big beautiful bill. So there is a lot in the media about this. There's a lot in the media about this. We're going to take basically questions at the end, but if you have questions throughout the meeting, feel free to put them in the Q&A section down below. So before I begin, I want to introduce Molen Associates, who we are, what we do. Molen Associates is a tax and accounting firm. We were formed in 1980. So we started with a lot of individuals, self-employed contractors, small businesses. We do everything from bookkeeping, tax preparation, even tax planning and IRS representation. So we try to stay ahead of these types of tax laws to help educate you, either clients or people that you work with. Just because it really does help to stay ahead of the tax legislation because this impacts you directly. Myself, I am a business owner. I've been in the tax and accounting world for about 8 years now. So I don't directly do taxes myself, which is why I brought Kathy Stump on here with me. She is really the expert here tonight. She's owned her own accounting practice. She's worked for Intuit. She's worked in public. She's done it all. So she is kind of a jack of all trades. She's really good. So if you have any questions, she is definitely going to be the one to answer them. A little bit about the One Big Beautiful Bill. This was pretty controversial. So when it passed, the House passed it by one vote, and then the Senate cut it even closer, and they went 50-50. So the Vice President had to step in, and they had to vote on it before it went to President Trump to sign it into law. So a lot of people have read about it, they've seen it online, but they really aren't familiar with what the One Big Beautiful Bill is. The easiest way that we can relate this is to the Tax Cuts and Jobs Act of 2017. So it was a massive legislative change back then, and it was a massive one just now. So there's a lot of changes, a lot of provisions. We won't go into all of them because there's some that are non-tax related. So we're really just going to focus on the tax aspects. There's a lot of, if you want to read more, feel free to do so. But this really does kind of change the rule book for taxes. It's not just, for example, if you play checkers and you play chess, you could be playing by the wrong rules. So make sure you know these. If there's something you think may apply to you, come talk to a tax advisor, make sure you understand it, how it applies to you. The tax law is like Swiss cheese. So there's full of loopholes and holes. The bill will plug some, but it'll open up others. So a good tax advisor will help you uncover those loopholes and say, hey, this could apply to you. You may not want to take advantage of it or do what it takes to take advantage of the loophole, but at least you know what your options are. So the One Big Beautiful Bill is not just for the wealthy. It really does impact everyone. A lot of the new deductions put into place for the credits, things like that, they actually have high income phase outs. So once you get above $250,000, $350,000 of annual income, you actually don't qualify for the deduction anymore. So it really does impact everyone. And the other thing to note is there's a lot of continuing rules. So the big thing with the Tax Cuts and Jobs Act is a lot of it was scheduled to sunset at the end of 2025, meaning some of those perks with the tax code were scheduled to go away unless Congress put them back into place. So some of these don't sound that exciting, but it is exciting when you see the numbers of what it could have been if the tax rates dropped or if the tax brackets, things like that, everything went back to how it was before. So as you go through this, make sure you've got a good team behind you, whether that's an accountant, a tax advisor, an attorney, a financial planner, a good banking relationship. All of this comes into play in taking advantage of the One Big Beautiful Bill. We're going to use a few question and answers as we go through this. Polls. So I'll start with one here, and it should pop up on your screen. So feel free to answer how you heard about us, whether you're an existing client, if we met you at a networking event, if your friend or family told you about us, or you just happen to find us online. One other note, we get a lot of requests to see these slides in the presentation. We will actually record the presentation, and at the end of the webinar, you will receive an email with a link to review it. So if you want to share it with someone, feel free to do so. The link will be It may not be updated immediately, but within an hour or two, it should be there. Okay, and one more question. How confident are you in your one big beautiful bill knowledge? There we go. So it looks like most people are not very confident, kind of up to moderately confident. So we're going to dig right in. We'll start with we're going to do mainly individual deductions tonight. We'll touch on a few of the business deductions, just because some of you may be business owners, and we want to highlight some of those, but I'd say 95% of what we'll talk about tonight apply to most individuals. So we'll take these one by one. You'll see on most of these slides, there'll be 4 different areas of the one big beautiful bill that we'll highlight. The first one are a higher standard deduction. So the standard deduction is one of those things that was put into place with the Tax Cuts and Jobs Act of 2017. It went significantly up and it just became permanent. So if it weren't for the one big beautiful bill, it would be resetting back to $11,000, but instead it's going to be at $31,000 for married filing joint. So pretty significant deduction for most people. One other thing I'll mention about it being permanent, because a lot of these will say it's permanent or it's scheduled to sunset. Anything that is permanent means that it will stay in place until Congress decides to change it. So that means that nothing has to happen, but it is possible that we'll change in the future, but this is as good as it gets. Another thing with tax rates, so the tax brackets were also extended. These were also scheduled to sunset. Like I said, doesn't sound all that exciting, but it is huge. So the one big beautiful bill locks in tax brackets at 10%, 12%, 22, 24, 32, 35, 37, eliminating that post-2025 tax hike. So this is really helpful if you're thinking about doing Roth conversions, if you want to lock in some of those lower rates now. The nice thing is these are indexed for inflation. So for most people, if your income stayed the same from 2024 to 2025, you'll actually be paying less tax in 2025 than you did in 2024, assuming all else stays equal. It's about $1,000 increase for that index for inflation from 2024 to 2025, so not a huge jump, but it is something. For the child tax credits, another small jump from 2,000 to 2.2 thousand, and these are indexed annually, so it will continue to grow with inflation. One thing to note on credits versus deductions. So the standard deduction reduces your income in which you pay tax. A credit is a direct dollar for dollar decrease on your tax. So it's a $200 credit, which really means that you're seeing a, let's call it a $2,000 deduction on income. So even though it's $200, that is pretty significant, especially if you have multiple children. So that's pretty important for people with large families or small children. One other item on this page, itemized deductions limitation. So if you're in a higher bracket, that 37% tax bracket, earning $750,000 or more annually, essentially your itemized deductions are going to be reduced by 2/37 of what they would have been. So kind of stinks, but hopefully it doesn't impact you. Kathy, anything else to add on these 4 here?
I think just the main thing is that everyone recognizes that you might not see a big change from this year to last year in the where the standard deduction is going to go up just a little bit. The rates are going to stay the same. We've kind of gotten used to those kind of things. They've been around since 2017, and they've been gradually going up year by year. But when we talk about it, they call it a cliff. We get to the end of that period, and the end of that period, the cliff for those things was the end of 2025. And so next year you would have seen a significant increase in tax, both from the standpoint that you would have had a much lower standard deduction, but also you would have been possibly in a higher tax bracket, and you would have gotten to those higher tax brackets much quicker because they had tightened the gaps between the brackets as well. So it's not a huge change from 25 to 24, but it's a huge change in what it could have been if this bill had not passed.
Perfect. That's super, super helpful. So once again, reminder, if you have a question about any of these, feel free to put your questions in that Q&A section, and we'll either answer it as we go through or get to them at the end there. Our next section here, and these are some new ones. So the extra senior deduction. This one is really cool. If you're over 65, you get an additional $6,000 as a deduction on top of what you would normally see. So this does phase out a little early. If your income is $75,000 of income single, $150,000 married filing joint, it does start phasing out. But this could be really important to strategize with your distributions. So if you're going to be taking RMDs or even just voluntary cashing out your 401k or your Roth IRA, things like that, I guess even more traditional IRA, make sure you don't increase above that threshold because you could start to lose some of this free deduction. So just a kind of a tax planning tip there. For charitable deductions for non-itemizers. So this is after 2025. There's a lot of weird dates here. So we try to include the weird ones. So after 2025, this one does go into effect, but filers can deduct $1,000 if you're single or $2,000 married filing joint for charitable donations, even if you don't itemize. So normally we have a lot of filers, they might donate $1,000, $2,000 to their church or to a nonprofit. But because of the high standard deduction, last year I think it was $27,000 roughly, it's kind of hard to get above that if you're not doing pretty significant charitable contributions. So most people just didn't get credit for it. It's still a good thing to do, but they didn't receive the tax benefits. Now this goes on top of that standard deduction. So that'll be really beneficial for a lot of filers. This is also made permanent. One other thing to note with charitable contributions is there will be a 0.5% floor on charitable contributions. So what this means is, for example, if your income is $100,000, you would need to have at least $500 in donations in order for them to count. So it just kind of adds a floor to make sure that it qualifies. For tips and overtime. So this is one that will be sunsetting out. So this is brand new, just with the OBBB, but you can deduct up to $25,000 in tips and $12,500 in overtime pay as a single filer, or $25,000 if you're married filing joint. And that evens out at $150,000 if you're single, or $300,000 if you're married filing joint. But this is basically just a direct reduction in your taxes. So huge if you're in the restaurant industry, but once again, it only applies through 2028. So it's just a few short years. So my recommendation is if you receive tips, you work overtime, things like that, take this short-term deduction and invest the money. Put it into a Roth IRA, put it somewhere where it can continue to grow, because in 2028, you're going to go back to pre One Big Beautiful Bill and have to pay taxes on this. For U.S. auto loans. So if you plan on purchasing a vehicle in 25, 26, 27, 28, or 29, if it's a U.S., I'm sorry, just through 28, not 29. If it's a U.S. manufactured vehicle, you can deduct up to $10,000 per year of interest on that loan. So there's phase out income limits on that of $150,000 and $250,000 for married filing joint, but that's pretty good as well. Anything on these ones, Kathy?
I think just make sure that you kind of watch if you are in the situation that you're earning tips. The tips are in industries that typically have tipped income. Restaurant industry is the big one, of course. Uber drivers, different people that have those kind of tips, that you make sure that they are reported correctly as soon as you get your W-2. If it's not, they're supposed to be making changes right now to the W-2 so that you'll have that information when you get ready to file your tax return. The tips will be reported right there on your W-2 for you, so that they'll know when your tax preparer yourself gets ready to prepare your tax return, they'll have that information. W-2s are supposed to be out by the end of January. And once you get past that deadline, it's kind of a little hard to get. If you find a mistake, try to get it corrected as soon as possible so that you have the correct information and make sure that you take that deduction for your tips. The same thing with overtime. That is supposed to be a separate line item on your W-2. And it's just really important, if you know that you worked overtime and you don't see it on your W-2, to go back to your employer as soon as possible so that they can issue that correction to have a correct W-2 for your tax return.
Perfect. Okay, the next section here, this is a really big one. So I am curious, I'm going to ask a question here. If I can pull it up. Do you know how much SALT you paid last year? So SALT is state and local tax. So this is could be income tax if you live in a different state, could be property taxes. So that's about like I expected. Most people is no. And that's not surprising because it's one of those things that people just turn into us and we decide, okay, does it exceed the standard deduction? Does it not? What a lot of people didn't realize is that the SALT taxes are capped at $10,000. So even if your property taxes are much higher than that and you live in a high income state tax, you're really not getting credit for it on your tax return. The nice thing with the One Big Beautiful Bill is that it has increased from $10,000 to $40,000. For 2025 through 2029. So once again, not 2028, 2029 on this one, but it is not permanent. This is just a short-term thing, so take advantage of it while you can. One thing to note here is if your income is above $500,000, you do start to phase out of this threshold. So if you're at $40,000 and let's say you start going into $600,000 of income, you will start to phase down, but you will never phase down below $10,000 of deduction. So it's not worse than it was before, but they're allowing for people that are in that kind of small to mid-sized income range, you do get a much larger deduction. So if you live in a high income state tax, Texas with property taxes, this is huge. But going through an example, I want to talk about some tax planning because of that threshold there. Let's say your adjusted gross income is $500,000 and you take you're going to sell something, you have an additional $100,000 of income, whether it's a distribution from a retirement account, whatever it may be, you're going from $500,000 to $600,000 of income. Everything else stays the same. So you got the same number of deductions, but you only get to count 40,000 with the 500, but when you get to 600, it goes all the way down to 10. So with that being said, it ends up costing you $45,000 in tax on $100,000 of income. So almost 50% just because of poor tax planning. So make sure you stay ahead of that. If you're right around that threshold, be sure to work with a tax planner because that can be huge. Anything else on that, Kathy?
I don't think so.
We have a question here. Does SALT tax include property taxes for investment properties?
Yes, it does.
Okay. Qualified opportunity zones will be our next section here. So this is go to that investment property. This is huge for investment, real estate investors. This was originally removed in 2021, but it's now been made permanent. So we kind of got used to it being gone, and it's nice that it's coming back. This is a great way to defer capital gains, and it's back and it's better than it was before. So the original plan, if you had money invested, the accrued capital gains, and you invested it, you got a step up in basis. If you invested it into a rural or a specific area that had this qualified opportunity zone designation. So now that investment window, the 180 days still applies, you can defer the gain up to 5 years. If you hold it for 5 or more years, you get a 10% step up in basis. If you hold it for 10 or more years, it becomes fully tax-free, and post-deferral gains can be held for up to 30 years. So huge opportunity if you are looking to take a pretty large investment and roll those capital gains over. A few other notes on this is the improvement requirements reduced to 50%, so it's easier to do, and the increased eligibility, so it's harder to apply. So a little easier, a little harder. This used to be, we called it the Wild Wild West. You just kind of did it. If it was a qualified opportunity zone, it was up to you, put it on the return. but the reporting is a lot more strict now. So there's a lot more compliance here. One other note here, there could be opportunities on a state level, not just on the federal level. So if you, for example, Hurricane Beryl, if there's things going on that Texas decides, hey, I want to designate this area as a disaster and we're going to make it a qualified opportunity zone, there could be specific opportunities for investment that you can use this. As an example, if you take $1 million capital gain and reinvest it, you would save about $240,000 of taxes. So huge opportunity just to hold it for 10 years. So not a bad rate of return already, but you can still make a profit on top of that. That's just the tax savings. Any notes on UOZs?
I think the important thing to remember, this is another one of those weird dates. That this doesn't, you can't start taking advantage of this until 2027.
So one thing the states should be having the proposed zones, they should propose them by July 1st, 2026, and then we can take advantage of it starting July 1st, 2027, as you mentioned. So if you got some investments, you can start thinking about it in about 18 months to 2 years. Trump accounts. So this is kind of similar to a traditional IRA in some forms or fashions. Basically, any child born from 2025 through 2028 will get a $1,000 deposit into this Trump account. Parents can also contribute an additional $5,000 per year tax deferred. So it grows tax-free, but when you distribute it, then you pay the taxes, just like a traditional IRA in that sense. Some of the major differences are how you can use the funds. So at age 18, so let's say you have a baby in 2025, you get the $1,000, plus you start contributing to it as a parent. At age 18 of that child, 50% of those funds can be taken out for qualified expenses. At age 25, 100% can be taken out for qualified expenses. And by age 30, the funds can be used for any reason. So it's not really a retirement account. It really is to help with those types of qualified expenses. If you take non-qualified expenses, they're taxed as ordinary income. But the qualified expenses count as long-term capital gains. So for most people, this is a pretty significant reduction in tax. So nice note there. For mortgage interest and casualty deductions, so the $750,000 mortgage interest and suspension of personal casualty deductions are now made permanent. So if you need that, that could be very helpful. Another note on 529 plans. So the increase, or the limits increased to $20,000, and the eligible expenses are now expanded. So you can do up to $20,000 for K through 12 education, and they have a lot more opportunities such as educational therapies for disabilities, trade schools, vocational schools, even licensing like an EA or a CPA. You can now use your 529 for things like that. And then for estate and gift planning. So this is basically an increased exemption. With the Tax Cuts and Jobs Act, prior to 2017, it was $5 million. And then in 2017, it went up to $10 million, and it has increased with inflation. But this is another one that was set to sunset after 2025. So we were going to go from, I think it was 13 last year, 13 million in 2020. Yeah, so roughly 13. We're going to go back down to almost 7. So pretty big drop. But now with the One Big Beautiful Bill, it's up to 15 million per person starting in 2026, or $30 million as a married couple. And it will continue to phase up with inflation adjustments. So if this applies to you, you have a net worth of that level, you should consider gifting, lifetime gifting, to leverage the expanded exemption. Any notes on these ones, Kathy?
I don't think so.
Awesome. Okay, so these next ones are primarily business deductions, credits, things like that. Do we have any business owners here? Either business owners or soon to be business owners? Okay, so it looks like we got a pretty good split here. So we'll go over these pretty quickly. Like I said, we want to focus on the individual ones because that's what this was targeted for. But just to mention a few more, bonus depreciation is huge for small business owners. So this means that 100% of assets placed in service after January 19th, another weird date, that happens to be inauguration day, but January 19th of 2025 can be depreciated. So the old phase down schedule went from 100% down to 80, 60, then down to 40. So it would have been 40% for 2025. We are now back at 100%. So this allows you to accelerate your depreciation. So if you own a investment property, you can do a cost segregation study and depreciate more of that property faster. So this is really good for cash flow. This can also be if you want to review your pass-through entity structures, if you have volatile income, so maybe some years are very high, some years are very low, bonus depreciation could be a really good way of almost flatlining your tax bill. So if you're going to jump up to 34% one year and then down to 24, you really don't want to be paying 34% income tax. You want to keep it down below 24, ideally 12% if you can. But this could be a good way to kind of reduce that if you have a business and you use bonus depreciation. It can also be coupled with Section 179. So it's a different, I won't go too in depth with this, but if you own a business and you're buying assets, things like that, you really should talk to a tax advisor about how to use Section 179 and bonus depreciation together. But don't forget about depreciation recapture. We see this bite a lot of people in the butt. It can be super helpful, like I said, for cash flow, for long-term planning, but if you don't plan ahead, it can create unintended tax consequences long-term. Anything on that one, Kathy?
I think it's important to note that assets that are placed in service need to be equipment, things like that. Real estate by itself does not qualify for bonus depreciation. The only way that you can get bonus depreciation on a piece of real estate is to do, like you said, a cost segregation that segregates out the personal property components of the property so that you can depreciate them faster, but also they would then qualify for bonus depreciation that you could take 100% of after January 19th.
One other note, so I mentioned reviewing your pass-through entity structures. So as a pass-through entity, you get QBI, Qualified Business Income Deduction, and it's 20% of your profit. We'll get into that in a little bit, but if you depreciate more of your assets, it actually reduces your profit, which then limits your bonus depreciation, or your QBI. So sometimes you're saving money on taxes here, but you're actually increasing your taxes somewhere else. So it can be really helpful to do a true tax plan and figure out where this applies to. One other thing I'll mention on this is check for state conformity. And we're in Texas. Most people here on the call are going to be from Texas, but certain states like California, New York, I don't know of any others, they don't stick to the federal rules. So just because you get bonus depreciation or 179 federally does not mean you qualify in the state level as well. Also for estate planning, this can be really beneficial. If you have a very large estate, you could depreciate certain items to bring that balance below the threshold. Yeah, I've got plenty of other notes on that, but I think that's plenty for today on bonus depreciation. For real estate professional status, rental income, and cost segregation, this is a little bit about what we talked about with the being able to depreciate your property. So if you have rental properties, you want to bonus depreciate or use some of that deduction faster, please talk to us. There's lots of different ways through a few of these strategies here. We talked about QBI, Qualified Business Income. This is also a deduction that was scheduled to sunset for 2025. So what this deduction is on your business, you have your revenue minus your expenses equals your profit. On that profit, you get a 20% deduction, basically as a gimme. You have to be in a qualified trade or business. There are certain thresholds for phase outs of your income. But basically, if you're a Schedule C filer, 1120S, a partnership return, you get a 20% deduction, no questions asked, if you qualify. So that was set to sunset in 2025, and it's one that a lot of our small business owners forgot about just because we got so used to it. It's very nice, but this was now made permanent, so we don't have to worry about it being renewed in the future. So make sure you review your entity type. If you happen to be a C Corp, it may not be worth it. We saw a lot of people hold out on their C Corps because they want to keep that corporate tax rate, but now that 199A is made permanent, it can be super helpful. There's also a minimum floor. So even if you have very, very small profit, it's almost like a gimme. They'll give you $400 QBI deduction, even if you're below that threshold. That's helpful. Once again, on this one, check for state conformity. Anything else on QBI, Kathy?
I don't think so.
Okay. Qualified small business stock. This doesn't apply to a lot of people. It's very underutilized. If you have a C Corp and you plan on making a large exit in the future, this could be something that's beneficial for you. We won't go into this too in depth, but if you have a business, you're looking to sell it and you are a C corporation, the other entities do not qualify, this could apply. R&D expense deduction. With this one, let me pull up my notes here. This applies for costs incurred after December 30th, 2024. Another weird date, not December 31st, December 30th. You can take those expenses all the way back to 2022. So the deduction limit has been raised to 2.5 million of income with a phase-out threshold of 4 million index for inflation. So this is another one that can be super beneficial if you are doing development, you're doing research. Very beneficial. Anything on that one?
No.
Okay. So we put together this cheat sheet here. So this has some of the individual strategies, some of the business strategies, but we kind of group them by income category. So depending on which income category you're in, certain things may apply. And once again, it's not black and white. Taxes are very unique to you. Our favorite answer for any question is, it depends. It all depends on your tax and circumstances. For example, you could be on a much lower income, but SAL tax could apply. Or you could be in a much higher income and it may not apply, depending on your situation. So take a screenshot of this or check it out in the presentation later, because it could give you some ideas for tax planning purposes. So we want to go through a couple case studies, because this is, to me, this is kind of how it seems more real when you go through a case study. So the first one we're going to go through for senior citizens. So anyone 65 and older. So meet John and Linda, age 68 and 66. Their income is $130,000 annually. They're taking out security, Social Security. They have a pension. Linda's doing some consulting and John works part-time. So pretty varied set of income. Generally, they take the standard deduction each year. They don't itemize, but they wanted to compare their 2024 versus 2025 taxes. So before, in 2024, they had to pay $11,930 under the old rules. In 2025, it drops to $9,656. So their taxable income dropped over $2,000, primarily with the tax brackets and the $6,000 senior deduction. So $2,000 tax is not a bad tax savings for really not changing anything. They didn't have to implement any strategies. This is just set it and forget it, let it apply, file a good tax return. One thing to note here, that $150,000 of modified adjusted gross income, you would start to phase out that senior deduction. So if they were to take some extra retirement distributions because they wanted to buy a vehicle or go on a big fancy trip, they could actually pay more in tax, not only on that new taxable income, but by phasing out that deduction. Not really tax related, but there's also some healthcare and Medicare changes that are OBBB related. So if you're on Medicare, please look into those. Another thing is This $6,000 senior deduction, if there's two of you over 65, that's $12,000 reduced income. If you're looking to qualify for an auto loan, a home loan, that means your income is now reduced by $12,000 a year. So hopefully that you're not that close to being on the edge for what you're qualifying for, but it is something worth considering. That's a pretty large amount of income swing. Mary is our next one. So hospitality workers. So it could be a restaurant worker. It could be really anyone that receives overtime or tips. So Mary is 32, living in Houston, Texas. So she has no state income tax. She's a single mom, has one child. She receives her income. She receives a base wage of $10,000, and a lot of her income is tips. So we'll say she has $22,000 of tips, and she receives, let's call it $4,000 of overtime pay. So total income of $36,000. She files head of household. So before the One Big Beautiful Bill and after, and this one I did two afters just to show a little bit of a case in point here. So before the One Big Beautiful Bill, she received a refund of $600. After the One Big Beautiful Bill, from 2025 through 2028, she received $2,200 of refund. And that's primarily because, as I mentioned, a lot of her income is tips and overtime. So that will phase out eventually. So after that phase out timeline, assuming state 2025 rules are in effect in 2029, so the income had phased out, which they will, but just oversimplifying, she'd still receive an additional $360 of refund. So even though the dollar amounts are small, $36,000 of income, that's quadrupling her refund. So one thing that she'll have to watch out for, as Kathy mentioned, make sure her W-2 is correct, that qualified tips and overtime they're distinctly marked on her W-2, it's reported correctly, because if it's not and it's just all general wages, she won't be able to qualify for this, and her refund will not quadruple like she expected it to. And another one, self-employed contractor. So Alex, he is a business owner, he's a contractor, he has a single member LLC, and his gross revenues in 2025 are $750,000 with profit of $250,000. So he really doesn't have any employees, he's just got a bunch of subcontractors, but he's decided to buy a $65,000 truck, $40,000 of equipment, and $30,000 in tools. So pre One Big Beautiful Bill versus after, he went from $29,000 down to $4,800 in tax. That is a huge swing. And a lot of that's because of bonus depreciation, Section 179, and R&D expensing, as well as QBI. So some of these are new, some are not. A lot of it's just not sunsetting, but it shows the ability for a business owner to take advantage of some of those strategies if put into place correctly. And that's a $25,000 swing in taxes, not income, taxes. So super, super big opportunity for business owners. And then last but not least, we've got a young family. So James is 45, Sarah's 43. They're both working professionals. Their household income is $165,000, primarily W-2 income. Maybe they've got some side income. They've got two kids, an 8-year-old and a 15-year-old. So before the One Big Beautiful Bill, they took the standard deduction, which meant their taxable income was $137,000. They had $4,000 of child tax credit, $2,000 per child, and their 529 plan could only be used for college expenses. So their taxes owed was $23,000. After the One Big Beautiful Bill, you can see that their standard deduction went up quite a bit, so their taxable income dropped, and everything else is assumed to stay the same. Child tax credit went from $4,000 to $4,400. So that's an additional $400 of tax saved right off the bat, just with that credit. This one doesn't really impact their taxes. The expanded 529 can be used for tutoring, dual enrollment, things like that. So if maybe their 15-year-old they need some sort of therapy, or they want to do a special course, they can use this 529 to pay for it. So their take-home pay can now go further. They don't qualify for the Trump account for the baby, but they can still contribute that $5,000 per year. So once again, it doesn't change their taxable income, but it can really help for the future. But their overall tax liability goes down about $700. So not a huge difference, but in today's economy with inflation and everything, I would say $700 is a win, especially considering that 529 in the Trump account, the ability to utilize tax advantage accounts for some of the spending that they'll probably do anyway. Kathy, any notes to add on those couple of examples?
I don't think so. Thank you.
Okay. So that is what we've got for you today. A couple other questions here. I'll put them up on the screen. We're offering consultations to go over the One Big Beautiful Bill and how it impacts you individually. If you would like a one-on-one review, please let us know. You can mark this yes or no. We'll give you a call and see if we can help you. A couple other items while you guys are filling that out. Tax planning is like a GPS. So staying ahead of this is like if you have a major roadblock in the way, your GPS, you want it to recalculate quickly. You don't want to have it 5 miles down the road, say recalculating, and you have to turn around 5 miles, turn around. So the faster you can recalculate, proactive tax planning is like that. So you can use quarterly consultations, you can use these One Big Beautiful Bill consultations to stay ahead of these changes. So some of these laws are in effect now, others in the future, some expire or sunset while others are made permanent. So this is extremely important to build into your tax planning, not only for tax purposes, but just long-term savings and investing. So make sure you stay proactive with this. And any questions? We'll open it up just for open Q&A. I think we answered most of the questions in the chat already as we're going through, but if not, feel free to repost those and we can answer them now. There we go, a couple more. Okay, one question here. How do I know whether I should itemize or just take the standard deduction? Kathy, do you want to take that one?
Sure. The way the standard deduction works versus itemized deductions is you get to take the larger of. So if you have, you know, just for example, say $1,000 over the standard deduction, it would benefit you to take the itemized deduction. Sometimes it's good to kind of plan between years, like if you always make contributions to your church, and you know that, you know, if you do them throughout the year, you can do some, maybe do more in 1 year so that you get above that amount. The other thing is kind of planning on how you pay your property tax. Fortunately for us here in Texas, most property taxes due in January, but you know what you pretty much can pay it in December if you want to. And if you're getting close on the standard deduction versus itemized and you want to take advantage of that, that's one way to kind of make that move in the right direction for you and get you to take those, whichever one's the larger is what you qualify to take.
Great, thank you. Okay, another one here. If my child turns 17 in 2025, do I still get a child tax credit?
I'm not sure that I know the answer to that. Under the old rules, you did not. But can we get your name and we will research that and call you back?
Yep, I'll put it down.
Okay.
Okay. One more here. Will these new rules affect how much I should withhold from my paycheck each month?
Yes, they will. And it depends on how you've been planning your withholding up to now. If withholding tables should change when they make the changes within the payroll software that your company uses. We've noticed in the past that those don't always happen very quickly. So sometimes there'll be a lull in when you get the automatic change. So if you feel like you're either over withholding or under withholding, it's probably a good idea to double check that yourself and make sure. And if you have to do a new W-4 to adjust your withholding, then it would be a good idea for you to do that proactively rather than just wait for the tax tables to catch up, because sometimes that does take a little while, depending on your employer.
Perfect. So we have a question here about medical deductions in a nursing home. We'll answer you offline because that's a pretty specific answer. But we do have one other question. Where can I get a list of what can be itemized? So for itemized deductions, what qualifies?
The three big ones, we can also get your email and send you the detailed list, but basically SALT deductions are a big one, and SALT stands for state and local taxes. That is your property tax, of course, if you live in a state that has state income tax. If you happen to live in a county that has any kind of a county tax, anything like that, that's the one that was limited before to $10,000, but is now up to $40,000 for the next 4 years. The other one is your charitable contributions, and of course that's the one that you probably have the most control over, because that's something that's at your option of how you're going to do that. Medical expenses are really hard because they are, there's a limit on them as well that did not change. It is 7.5% of your gross income. So in other words, your medical deduction expenses to be deductible have to be over 7.5% of your income. So it's basically only things that are, pretty catastrophic expenses, a large surgery not covered by insurance, something like that, before you would qualify for medical expenses. And those are the three ones that people talk about the most, is taxes, and then of course the interest on your home, mortgage interest. And that's depending on in the early years of your mortgage, you're paying a lot more in interest, of course. And that's and usually a lot more in taxes as well, property taxes. So those are the three main items. The miscellaneous items that people used to be able to take, like tax prep fees and safe deposit boxes and stuff like that, were repealed before 2017, and they were not brought back. In fact, the repeal of those was made permanent. So that's the three big items: mortgage interest, state and local income tax, and charitable contributions.
Perfect. Okay, another question. What challenges arise from the expanded standard deductions and child tax credit changes when preparing individual tax returns, especially for middle income earners?
Would you repeat that, please?
Yeah, what challenges arise from the expanded standard deductions and child tax changes when preparing individual tax returns, especially for middle income earners? So if I were to take a stab at that one, I don't think there's really any specific challenges. Two things I would note are, on the standard deduction, a lot of middle income earners, that's when you start to see that SALT cap come into play. So you may have had the standard deduction before, but you may be itemizing now. So it's really just determining what's better for you, standard deduction or itemized deduction. And then for child tax credit, as long as your child applies, you just get more benefits. So there's not really any complexity with that one. Next question here. What strategic moves should businesses make to maximize benefits from increased R&D deductions, semiconductor manufacturing credits, and bonus depreciation?
The R&D credits are the big change in those is that they're immediately expensed. It is, if you've not done R&D before, if you're doing it yourself, there is some complexity to it. It is a highly audited credit, and you need to make sure that you're just keeping your documentation of how you're performing your R&D, what the product or service is that you're researching and developing to change. It is supposed to be under like kind of scientific methods so that you can prove kind of what your hypothesis is and what your goal is and what you're trying to figure out and what the results are. So the biggest thing with R&D is, of course, just document. There are companies out there that can help you with that, making sure that your process is correct and that the process that you're using is documented. The bonus depreciation is basically, I always recommend that if you need a new piece of equipment and you have an advantageous time to take it, as long as it's going to be something that you would have purchased in the next 1 to 2 years. I never recommend buying something just to get a tax deduction or tax credit, but it does give you some planning opportunities to say, okay, I know this machine might last me another year or two, or this vehicle is kind of on its last leg. Is it time? And with these new bonus depreciation rules, that can make that decision that you would make from your business a little bit easier to, you know, kind of have some leeway in how you plan for your asset purchases.
Perfect. If I were to add on to that one, because the question asks, what strategic moves should businesses make to maximize these? And the answer is really, it depends. Every business is going to be different. Certain businesses will really benefit from R&D, where others are going to be more bonus depreciation or other types of credits. So it depends. If your business you think will qualify for those, I strongly encourage you to schedule a consultation so we can take a deep dive and see what qualifies, what wouldn't qualify, how to maximize other credits and deductions. And we got one last question here. Does the SALT, basically a SALT cap, does that apply to Texas as well? So state and local taxes. Is that in Texas or just the rest of the U.S.?
The SALT limitation is a federal limitation, so it applies to all states. States that have high income tax that have been limited by that for the last several years would have an increased interest in this. Of course, we don't have state income tax in Texas, so ours is basically, kind of combining property tax, if you've got any, sales tax on a vehicle, if you purchase a vehicle in the year, those kind of things. So it is really dependent on which state that you're in, depending on what your deduction could potentially be.
Perfect. Thank you.
Mm-hmm.
Well, thank you guys all for joining us. We're about out of time for today. So a couple next steps here. As I mentioned at the beginning, everything here is recorded. It will be saved and you'll get an email sent to you with a link for that recording. So if you want to come back and rewatch it. If you have any specific questions, feel free to send us an email, or if you want a one-on-one consultation, you can call us or email us here. If you own a business or are planning on owning a business, scan this QR code and you can schedule a consultation with us to see if we're a good fit. Even if you don't own a business and you have individual taxes, we'd love to help you. So thank you guys for joining us, and hopefully we'll see you on our next webinar. Have a great night.
Have a nice evening. Bye-bye.